Good morning, everyone, and welcome to this morning's virtual briefing, the ANZ Property Council Confidence Survey quarterly results. My name is Danny Hunter. I'm the Victorian Executive Director here at the Property Council of Australia. And before we begin, it's always a privilege to acknowledge that I'm participating in this event from the lands of the Wurundjeri Woi-wurrung people here in Victoria. And let us all just take a moment to reflect on the meaning of place. And in doing so, I recognise the traditional lands on which we are living and working and pay my respects to elders past, present and emerging. And at the Property Council, we celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of Australia. It is my great pleasure, and I do have the great honour today to welcome everyone to what's becoming quite a regular event in our Property Council calendar, the quarterly ANZ Property Council Confidence Survey results. And we're doing this time by virtual briefing, and it is the 5th time that we've done this on a virtual event, and we have over 100 people from around the country tuning in today. And speaking of the numbers, this year marks a very special milestone in the Property Council and ANZ research partnership as we hit 10 years of that partnership. And in that time, we've had over 81,000 responses to this survey, which is amazing. So a big shout out to our research team, ably led by John Newen and the team at the Property Council, who put so much effort into our research program, particularly this one. And I know I speak for the whole of the Property Council when I say it has been an absolute pleasure working with ANZ these last 10 years. And without their support and providing this important industry resource, it wouldn't be possible. So thank you so much, particularly to David Plank, Head of Australian Economics, and Felicity Emmett, Senior Economist, and we'll hear from Felicity later on this morning. But thank you for your deep involvement with the survey and with the Property Council. Thank you for everything you do in that regard. I'd also like to acknowledge now Russell Martu, Managing Director at RCP, and his wonderful team, who have also been long-time supporters of the survey and a fantastic partner to work with over the last 5 years. We really are very lucky here at the Property Council to have such incredible partners who believe in what we do and who are always willing to align with us on these exciting initiatives. So finally, after thanking Felicity and Russell, it is almost time to hand over to Russell and get into the events of the day. But before we do that, I just want to remind everyone to think of your questions for Felicity and to ask them through the Q&A function on your Teams program, and we'll go through them in a bit of a curated conversation in the second half of this session. But now let's get into it. Russell, over to you.
Thanks, Felicity. Yes, as Felicity said, I'm the Managing Director at RCP, and we're a project management and consultancy company here nationally in Australia, and we're the supporting sponsors to ANZ for the quarterly surveys. As Felicity's just done the introduction, we're also joined by Senior Economist from the ANZ, Felicity Emmett, and Danny, who's the Executive Director from PCA in Victoria, will be hosting the event as well. So further to the press releases today in the national press regarding the results for the current survey, we're pleased to be able to bring this online event to all of the Property Council members. It enables us to better understand the September quarterly survey, and Felicity from the ANZ will provide her insights and analysis on the Australian property industry sentiment and the broader economic outlook at a national and a state level. So we're looking forward to that commentary from Felicity. RCP is pleased to be supporting sponsor for the survey now for some years, and we continue to see the great benefits and insights which are represented in the survey results each quarter. The format for today will be Felicity will present the findings from the survey and share her views on the impacts on our industry and the broader economy. And then following Felicity's presentation, we're delighted to have Danny Hunter available to facilitate discussions and take questions from participants regarding the presentation. We're scheduled to wrap up in about 45 minutes, so I'll now hand over to Felicity to run through her presentation. Thanks so much.
Thanks very much, Russell, and thanks, Danny. And, you know, I would like to reiterate some of those comments around our appreciation of the PCA and this survey. It certainly really helps us to understand the property sector within the context of the broader economy. This is a fabulous survey where we get a lot of information that's just not available from the regular economic data from the ABS and other surveys. So it has very much helped to complement our understanding of the economy over the past 10 years or so. And thank you everyone for joining today. It is, I think, a really great survey results that we've had in the September quarter. Surprisingly resilient is really how I would describe them. If we look at that first slide, that first chart up there, that really shows the level of confidence. And as you can see, we did get a decline in the latest survey. That's the second consecutive decline, but the decline has been quite modest, and as you can see there, it's coming off that record high that we saw in the March quarter. And so if we look at where it is compared to the long run average, which that light blue line shows there, it's still well above. And I think that's incredibly encouraging, given that the survey was done in the first 2 weeks of September when both New South Wales and Victoria were under lockdown. We still are. And so I think that it really shows how businesses are able to look through these current lockdowns and are feeling really quite positive about the outlook. Obviously, the still enormous level of fiscal support that is really helping to bridge the gap over these last few months in terms of household incomes and also business incomes, and the fact that interest rates remain low has really helped to keep confidence high. And really critical as well has been the vaccine rollout, where, you know, we're really now approaching, you know, in some states we've reached that 80% first dose, and broadly I think we can be pretty confident that we're approaching that 80% full vaccination rate, and that is keeping people hopes alive that we won't have these shutdowns anymore. So the next slide shows the breakdown between residential and commercial property confidence. So in these charts, what I've done is I've just collated the responses from people in the residential sector to comment on residential or commercial, and you can see there that residential still looking very strong, you know, only a little way off its highs, but, you know, compared to history, very, very strong, and compared to pre-pandemic levels, very high. And obviously the amount of work in the pipeline and expectations for price growth there is really helping to support residential confidence. On the commercial front as well, you know, we did see a small decline. That's the first decline that we've seen since the big drop down there in the time of the pandemic last year. But it still is actually just a touch above its long run average. Within commercial property, we can really see that there have been some sectors that have, you know, really are winners out of the pandemic, the industrial sector in particular, and we'll talk about that later, and retail to some extent, while, you know, where sentiment around office and hotel property is still pretty depressed at the moment, but generally off its lows. So if we have a look at the next slide, and I think this one is really pretty important. This is economic growth expectations. So like most of the survey. We have seen a decline, but it is still running well above long-run average levels, and firms are really feeling pretty confident about the outlook. So we've got a net balance of 18% of firms expecting the economy to expand over the next 12 months. So it's interesting when we look at the state breakdown of these economic outlooks, we actually see that the outlook has deteriorated most in those states that haven't been shut down, so Queensland, WA, Northern Territory. And I think part of that is because in Victoria and New South Wales, what we know with Delta is that it hasn't changed the outlook. In fact, the outlook is probably stronger. There's probably an element of pushing some of the work out, particularly in construction. And so, you know, many firms in New South Wales and Victoria will be looking towards quite an economic rebound. And if we think about what we'll see from here on in economic growth, is it will be stronger in New South Wales and Victoria as we catch up a little bit to those states that haven't had these very extended periods of being locked down. So that is, I think, really integral to it. As I said before, the fiscal support, the monetary support and the vaccine rollout are other sort of broader factors that are really helping to support sentiment. And the next chart there shows the forward work schedule, and this is really interesting, I think, because when we look at things like the economic outlook or things like the construction outlook or prices outlook, that's what firms are reporting they think for the general industry. But when we look at forward work schedule, this is what firms are reporting about their own firms. And I think this is something also that's clearly helping to underpin confidence about the outlook, is that firms actually do have a very substantial pipeline of activity ahead. Now, this is really obvious in the residential sector that we'll talk a little bit more about later. But, you know, even on balance, we're seeing these quite significant pipelines of activity, and that is making people feel more confident about the outlook. The next slide shows residential indicators, and you can see there that dark blue line, the forward work schedule is very elevated. Obviously, with the home builder program and lots of the other state programs have really helped to support construction, and the outlook there is very good. You know, we've got 51% of firms saying, a net balance of 51% saying that the outlook for construction is very positive. Now, there is obviously a split there between firms who are exposed to detached houses, which have really boomed, partly due to home builder and partly due to some preferences for larger living spaces, rather than apartment approvals, which haven't done so well. So we actually have some more data out today on building approvals, and that will be interesting to see there. But what we have seen over recent months is that while house approvals are coming off quite quickly, and that's something we'd expect to see given that there was a bring forward of activity associated with the home builder program. What we're now starting to see is unit approvals starting to creep higher, and that's also consistent with the fact that we're seeing investor housing finance pick up as well. So the increase in unit approvals is encouraging because it will extend the life of the construction cycle, and I think that that is something that we can really look at as key. Now, the other thing there is the prices. So prices on the light blue line, still the expectations still very high. 72% of firms in the residential sector saying that they expect price gains over the next year, and that's really consistent with what we've seen. Prices are up around 17.5% over the past year. Interest rates are set to remain low. The RBA just over the past few weeks has come out and confirmed and been really very strong in its statement that it doesn't expect the cash rate to rise until 2024. You know, currently at 0.1%, that's a very long time for such low rates, and the way that those low rates work is to lift asset prices. So this is something that all else equal, we could expect to see further gains in house prices, and that is our expectation as well. So on the next slide shows that state breakdown. You can see those expectations for strong price growth is really consistent across all of the states. And you can also see there how quickly it turned around from early last year. But, you know, if we look state to state, the expectations are strongest in Queensland. I mean, I must say that there, when we look at lots of these measures, Queensland is certainly doing very well, particularly in Resi, and in New South Wales. Queensland expectations for prices actually rose in the latest quarter. So things really are looking, I think, very positive there. You can see there also, I think this is the first chart that shows that those state breakdown, and Victoria, the least confident about the outlook for prices. I mean, that certainly is a little bit of a theme that we have seen through this survey. Generally speaking, confidence in Victoria across a range of measures is lower than the national average, and obviously reflecting the fact that it has spent the longest time in lockdown, so it will take a little bit longer for that economy to recover. So the next slide that I have there shows debt finance availability expectations. Now, I put this in given that, is that security? I don't know. I'm not sure. Yep, great, thanks. So that that debt finance, you know, you can see. So what that chart's showing is the line is still above zero. So people generally think that debt finance will be easy to get, but fewer people think it will be easier to get. So it's still a positive sign, and you can see over history it's still much higher than it has been. And that reflects, you know, the wash of liquidity through the system, the way that the RBA is really trying to stimulate activity through that. But I think there are rising concerns, and this is perhaps more over the past couple of weeks rather than captured in the survey, around macroprudential measures. So yesterday we had the Council of Financial Regulators issue their quarterly statement, and they really honed in on the residential lending. They're not really worried about bank lending or bank stability. What they're worried about is that that household debt will grow so much that it will become an impediment to consumer spending, and that if we saw some other sort of economic shock, then households who are overly indebted will pull back on their spending very quickly, and in that way it becomes a macro stability issue. And so it does look as though we'll get some measures to curb credit growth. I imagine that they will be very light touch in the initial stages, but I think we'll probably get something by the end of the year. So the next chart that I have there is on the construction outlook for residential. Again, you know, it's very strong and very strong across the board. You can see we actually had increases in expectations again in New South Wales and Queensland. Victoria, the expectation is the lowest among the states, but still quite positive. So there is a very large amount of work in the pipeline there, given the massive increase that we've seen in building approvals in the year to about March, when Home Builder finished up. So that outlook is really, really good. And even though with New South Wales and Victoria, we've both had periods where the construction sector's been fully shut down, and that, you know, it's really working well below capacity when it hasn't been shut down, given the social distancing requirements, and that will impact on activity in the current quarter and while those social distancing requirements are in place. But firms know that they have this pipeline of work, they've got X number of houses to build, so they're confident that they've got this pipeline of activity, which is really helping to underpin sentiment there. So the next chart there I have there is around commercial property, and so this is really, you know, shows the different sectors, and you can see there industrial property is an absolute standout in terms of its performance over the last year or so. I mean, it has been a very big beneficiary of the development since the pandemic, the shift to e-commerce and online sales, and the resulting increase in demand for warehousing and logistics properties has really helped to lift the construction outlook, the prices outlook, the forward work schedule and employment. So it is really looking very strong on all those measures. Like most of the indicators in the survey, it did see a decline in the latest survey, but still at very, very high levels. The other one I mentioned earlier is the retail sector. So it's that dark blue line in that chart. So it's actually, sentiment in the retail sector is the lowest of all the commercial property sectors. What I would say, though, is that it's actually higher than it was pre-pandemic. You know, retail has obviously had a lot of challenges over the past few years, you know, shift away from department stores and shopping centres. But, you know, the pandemic has really lifted demand for goods when people don't have as many services to spend on. We were joking before this about how long we'd all had to wait for haircuts. Haircuts are services, you know, overseas travel services. People have a lot more money to spend on goods because they can't spend it on services at the moment. So retail really has been a big beneficiary, and that's why we've got that slightly higher than pre-pandemic levels of confidence in the retail sector. So the other two sectors, they're office and tourism. Clearly, you know, they're down in the latest survey, but also down from their pre-pandemic levels. Tourism suffering from the closure of international borders, with hotels really badly affected, given that the loss of overseas tourists that tend to stay in the CBD in the large hotels. You know, the outlook now with borders set to open gradually shortly, the outlook I imagine will start to improve there for that sector. Office is a little bit more complicated, obviously. You know, we're seeing this at the moment, lots of people working from home with the lockdowns, but also a shift to a more permanent work from home presence. Lots of firms adopting a hybrid model where their workers work part of the time at home and part of the time in the office. So that's obviously a challenge for the outlook for office property over the more medium term. And then the last slide that I have there today to talk about really just, you know, highlights the points that I'm just making there. So these are survey responses showing which sectors are most affected by COVID. The hotels and tourism sector, they're getting the most votes, that being most highly affected. Initially, you can see for commercial office that there was, that there wasn't the perception that that would be so heavily affected, but over time we've seen that rise, as I think that respondents really, it's brought home that there will be some longer term issues and challenges for that commercial office space. But the next survey is going to be in November, and given that I would hope that New South Wales and Victoria will both be open then, most of the states will have reached that 80% level of vaccination, and we could see an increase in sentiment there, particularly around that hotel tourism sector if borders are actually opened. So that's the end of my presentation. I'll hand back to you, Danny, now, and we can answer all your questions. So please, if you do have a question, pop it up there in the Q&A. I'm very happy to answer anything.
Thanks, Felicity. Well, you're talking about borders reopening, confidence, and also these sort of bright sparks within the various sectors in the property industry across the country, and that's a really welcome and encouraging tone that you've taken today, and we can really see that through the survey results. So let's get into questions after that incredible presentation, and we'll dive in deeper to some of the areas, but I'm really keen to take questions from our audience as well. So please do, as Felicity said, ask them through the Q&A function, and we'll work them through the conversation. If you can pop your name and your company in there as well, we can attribute those questions to you. So Felicity, property sentiment, as you outlined, has edged lower, but it remains elevated, highlighting the resilience of the sector and the economy more broadly. What, in your mind, are the top 3 things underpinning the sector's resilience?
Yeah, that's a good question, Danny. And it's something certainly when I saw the results, I did ask that question, but the survey itself, I think, gives us some answers to that. And I think also, we can see, the broader economic data is showing that businesses are looking through the lockdowns, and they do think the economic outlook is quite positive. You can see that in other business surveys like the NAB business survey. You can see it in things like consumer confidence, which, on both those measures, the survey results have deteriorated, but nowhere near as much as what we saw last year in the national lockdown or in the Victorian lockdown. And the other thing I'd point out is that when we look at something like ANZ job ads, they've fallen about 4% over the past 2 months. Now in the national lockdown last year, they fell about 60%. So it's clear that businesses really feel confident about the outlook because they're still hiring, they're not wanting to let go of their workers. So I think that this confidence in the economic outlook is really underpinning that sentiment. But that confidence in the economic outlook, I think, is really helped by the fiscal support. So we've had both the federal government and the state government step in with, slightly different sorts of support than we had last year, but certainly helping to support household and business incomes through this period. And we've also had the Reserve Bank keeping monetary policy very, very accommodative to help support lending. And so that I think has really helped. And then, so And then the third thing that I would highlight is the vaccination rollout. That is critical to the outlook. Nobody wants to go into further lockdowns, and I think that is giving us confidence that we won't have these long, extended, full lockdowns once we get to those critical sort of 80% plus levels. I've got to say that when we look at the outlook, the biggest risk to the outlook is the pandemic itself. We didn't predict the Delta wave. We can't really predict another more virulent variant of COVID, but it's a possibility. But I think now that we have those vaccination rates up, we have a plan, there's likely to be booster shots, that is really making firms and households as well, confident about the outlook.
I think that's right, Felicity, and also, we're not pursuing this, the unreachable zero anymore. We've seen some really high case numbers, and we've also seen them come down as vaccination rates increase. So our national psyche around the outlook for those numbers has shifted, I think, really quite significantly. We're getting some really great questions already through the Q&A function, and I'll just start with, I'm going to combine a couple of questions here that are asking along a similar theme, but they're particularly, we've got people particularly interested in the impact of when the borders reopened, and particularly the impact on residential markets once, international migrants and international students come back into Australia.
Yeah, no, this is a really good question. Now, many of the people listening and watching today would remember at the beginning of the pandemic when we closed our borders and there was widespread expectation that house prices would fall very sharply, because we all knew that Australia has had very strong population growth for many years, and that was helping to support the economy, but also helping to support the housing market in terms of construction and prices, and was largely behind the expectations for falling prices, and as we all know, that didn't eventuate. So it's really clear, I think, that the main driver for house prices is interest rates. It's that asset price issue, and that has been a driving factor. I don't really think that once borders reopen, we will see a lot more pressure on the housing market. I think that the population gains will be relatively slow. The borders are only going to open quite gradually. People, when they first come to Australia, they tend to rent. So I don't think that we're going to see another really large lift in house prices then. I think that once the lockdowns end, we might see a little bit more confidence come back to the market from domestic investors and owner-occupiers. But I don't think that we'll see another rush in prices once borders reopen. And that's especially the case given that we are likely, as I mentioned, to see some sort of macroprudential controls introduced either by the end of this year or early next year.
So, Felicity, I think there's so much in that. I mean, there really is so much to go with respect to how government opens up the economy again, how we reopen borders. So let's talk about some of the constraints that might actually kind of be a little bit of a handbrake on the realisation of this positive sentiment. And we've got a couple of questions here, particularly around supply shortages and labour shortages. And I'm interested in the dynamics you see at play there. Do you think the confidence is going to be somewhat hampered by the practical realities of just trying to meet the demand that we have in the market?
Yeah, look, absolutely. There are really quite significant issues around supply constraints and about finding suitable labour. and this is something we were seeing prior to the lockdowns, and it really hasn't abated. And we're seeing that play out overseas in the inflation numbers, in particular in the US, where those supply constraints are really feeding through into higher prices and, in some sectors, higher wages. So in Australia, so far, the issues around supply constraints haven't really fed through to higher prices, obviously at an aggregate level, sorry. So we're seeing pockets of this. We're certainly seeing different sectors report very significant increases in input prices. And I'm sure lots of the people on the line have seen that in their own businesses. But what we're not seeing is that flow through to broader measures of inflation. So whether that's because firms don't feel they can pass those prices on, or whether it's being washed out by other firms that aren't seeing those prices, it's not flowing through. So it does seem to be really much pockets of that goods price inflation. And on the wages front, it's very similar, just pockets, and on the whole, we're not, wages growth remains very weak. And so firms, I think, are finding it difficult to get labour, but they're not yet at the point where they're ready to offer higher wages, or that's, from an aggregate sort of perspective. So it will be interesting to see how this plays out, because if it could definitely constrain output. It could, if people can't get the workers that they need, then it will constrain output. But it is just a really interesting phenomenon. I don't have the chart in the pack, but I have a great chart, and it shows the percentage of firms reporting that labour is a constraint, or finding suitable labour is a constraint on their output. Now that measures near a record high at the moment, while wages growth is very, very low. So it does seem at an aggregate level that so far, firms are probably, to some extent, perhaps biding their time, waiting, and not wanting to attract more workers by paying higher wages.
And Felicity, without having that chart in front of you, can you tell us, is that concentrated in particular capital cities or states?
Look, it's just an aggregate measure that we get. We don't actually get it broken down, but you can see in the wages data, it is pretty weak across the board. So what's happening is that there are definitely some pockets where there are wages pressure. So there might be a few people in a few industries getting sort of 4% plus, but most people are getting between 0 and 1%, and that is really holding down overall wages growth. But I understand that there are lots of people on the line shaking their heads going, that's not my experience, because there does seem to be, quite a variation, and construction in particular is where we're definitely seeing the strongest price and wage pressures.
Let's keep going with the theme around residential particularly, and residential sentiment in the survey remains really well above the long run average and even pre-pandemic levels of sentiment. It's very topical in the last couple of days, the talk of macroprudential controls and regulatory changes to sort of control house prices, and you touched on that already. What's your outlook on this, and to what extent are interest rates and borrowing capacity sort of driving the residential sentiment that we see in the survey?
Yeah, no, that's a great question, Danny. I think it really is interest rates that's driving it. Housing is a funny thing. It's a consumption good. We need somewhere to live, but it's an asset as well. And so when interest rates are low or interest rates fall, then it boosts those asset prices. And we've got interest rates very low at the moment, and they're set to stay low for a long time. So people are, it's right to expect that the value of homes goes up, and also it's something that is likely to continue, as I said before. But the Reserve Bank has, interest rates as its main tool to use for the economy. It's obviously used some other what we call extraordinary measures over this the pandemic period with quantitative easing and yield curve control and the term funding facility. But the cash rate is its main tool, but it's very blunt. And so what we're seeing now is that those higher prices mean that people have to borrow more, and so levels of household debt are rising. And now if we look at the latest numbers, when we look at household credit, it's annual growth in household credits growing at about just over 10% at the moment, but income is growing, or has grown on average about 4% per annum over the past 10 years or so, or prior to the pandemic. And so what's concerning is that people are borrowing, or this growth in household debt is really outpacing household income, and it just puts a burden on households, particularly if there is, as I say, some sort of shock, and then they will pull back on their spending. And it was something that we actually saw prior to the pandemic, that consumer spending growth was very soft. So it is something that the regulators are really concerned about, and I think that we will get some measures. Now, it's because they're worried about these high debt to income loans. So if we look at loans that have a debt to income ratio of 6 times, so if your income's $100,000, you're borrowing $600,000, that they have reached a record. The series is very short, so record is probably overstating it. We only have about 3 years of history, but it's a record of just over 20%. And this is where the regulators are worried, and that's likely to be where the measures are concentrated. So they're likely to limit the share of high debt to income loans that banks can issue, and that will affect investors primarily, and also to some extent, but a bit less, it will affect first home buyers, and it will likely see price growth slow. Now, price growth's already slowing a little bit, but it still remains very strong. But I think that the regulators will be really very, very careful to go very lightly. Again, if you look at that period through 2018 up to May 2019, we saw house prices falling quite significantly, and that flowed through to the broader economy, and the economy was really quite weak. So the last thing the Reserve Bank wants to do is to stifle the economic recovery by crimping house prices too much. So they will be light touch, I think, but it will see a slowing in house prices.
Felicity, let's move on in the last moment or so that we have to the commercial sector, and the Property Council's Office Market Report is one of the key research releases that we do twice a year, and it shows particularly that there's going to be quite an injection of new commercial stock into our major capital cities. A question from our audience is, how does the market view impact the shift towards a hybrid working model, and what do you pick up from the sentiment around our commercial office sector and this shift that we'll likely experience, or that we are already experiencing, between our working from home and working from the office model?
Yeah, look, I think it is going to be a challenge. When you look, the ABS did a survey in April. At that time, 30% of businesses said their workers were working from home. So this is prior to the latest lockdowns. Of those 30%, 80% said that there would be some sort of work from home on a permanent basis. I know lots of firms, lots of large CBD firms have moved to this hybrid model. I mean, ANZ is one of them, where we come into the office sort of 2 or 3 days a week. once these lockdowns finish. So I think, so what it has meant is that there has been a decrease, obviously, in occupancy, an increase in vacancy rates, and I think the RBA said that in their own business liaison, around 25% of firms in their liaison, which would be concentrated on CBD, large CBD firms, 25% said that they were wanting to reduce their office space by an average of 25% as well. So I think there will be these longer term challenges for office. I mean, some of that will be offset by the fact that we might want a little bit more space in the office, and that will help. But I do think it does mean that it will be challenging for that sector going ahead.
Well, Felicity, we've certainly covered a lot of ground today, so thank you so much, as always, for your incredible insights and for the detailed input that you give us and our audience, and for the time you put into the presentation. That's all that we have time to go through today, and there's a lot of questions I haven't been able to answer or ask, so I'm sorry about that, but please do keep them coming in our future virtual event series. And before I hand back to Russell to close the show today, I'd just like to acknowledge once again the ANZ's 10 years of support for the Property Council ANZ Confidence Survey, and also RCP's ongoing commitment, as well as the incredible work put in by the Property Council's research team. Thank you both, and thank you all for the generosity over the years that you've shown this program and for your commitment to the survey. I'm very much looking forward to the next one, and they absolutely continue to be a hallmark in understanding what issues really are at the heart of the property sector in any one quarter. That's all for me. It is time for Russell to close the show. Thank you, Russell.
Oh, thanks, Danny. And look, thanks to everybody taking the time today to be part of the discussion. It was certainly a really great opportunity to hear firsthand the in-depth analysis behind the headline data that we've seen in the graphs that have been produced. Sincerely, a big thank you to Felicity from the ANZ. Great presentation again, Felicity, and your commentary and insightful analysis of the data and looking to see what the future might hold was first class. And also Danny from PCA, excellent job facilitating the discussions and guiding us through many of the important issues and the questions raised by the audience. So thank you to both of you for excellent job this morning. Also, just as Felicity said, I'd like to thank all the participants today taking the time to be involved in the event. I trust that you personally have gained a great insight around these current issues that we've been discussing. Thanks to the PCA team. There's a lot of hard work goes into putting together these online events. And I'm sure that everyone will agree that this is time well spent by the PCA to support the members of the Property Council in their understanding of what are pretty uncertain times at the moment. So from me, have a great day. Look forward to talking with you all in the near future. Thanks so much. Have a great day. Bye.